I want to look at The Trade Desk. This was a company that was really popular a couple of years ago. It got massively overvalued and has since fallen quite a bit. The Trade Desk is one of the largest providers on the buy-side network of ads. What we do, we provide a platform for ad buyers. Most buyers are ad agencies, brands, or other technology companies. We've been profitable since 2013. Very good to see. One of the most impressive parts, I think, of the company is their consistent ability to grow very quickly. The total amount of money that flows through their platform is about $12 billion, which is up 25%, up 26% in terms of revenue. The open internet is a $935 billion market and getting bigger. And they are incredibly well diversified across all sorts of different industries, which is good to see. They are able to operate effectively in a variety of ad spaces, not just like one ad space in which they are particularly effective in. One of the other cool things about the Trade Desk is they're growing immensely outside of the United States. The total ad spend is 88% in North America, but everything else growing very rapidly. So total assets is about $6 billion, and total liabilities is only about 3.3. The vast majority of that is accounts payable, and so they basically have no debt. The revenue is also growing exponentially, right? So year over year, 3 months ended, 628 million to 739 million. What is also very cool is sales and marketing. The actual expenses that it takes to run this company is not growing nearly as quickly. It cost them $60 million to make an extra $110 million. And it only cost them an extra $60 million to do it. And they are repurchasing shares. They repurchased almost $1 billion worth of shares. So I looked at this company a couple of years ago. One of the things that I complained about with this company specifically was they were issuing a lot of shares, right? So their shares went from 464 million outstanding to almost 500 million. They had diluted their shareholders by almost 10% when I initially started talking about this and writing about this company. And at the same time, granted, they were growing very quickly, right? They were doing, 25% revenue growth every year. And it's like, okay, that sort of makes a lot of sense that, you're doing a lot of revenue growth, but you're diluting your shareholders. And so the Trade Desk has started to prove that revenue growth is not only durable, but they can do it while they're actually buying shares back. I am curious about these giant falls, though. Is this just because growth is slowing, or is this like structural problems in the company? I do not know. Why did it crash 40% in February? Shares of the Trade Desk plunged 41% in February 2025. The digital advertising's experts' fourth quarter report fell short of Wall Street's revenue targets on February 12th, raising questions about the company's growth prospects. The Trade Desk was no slouch in Q4. Revenues rose 22% year over year, landing at $741 million. Adjusted earnings jumped 44%. Management's guidance for this period called for revenues of at least $756 million, so they missed by about $15 million, which is 2% miss. Let's see August. CFO departure. Trade Desk tanks 39% for worst day ever on CFO departure and competition from Amazon. Shares on the Trade Desk fell 40% on Friday and headed for their worst day on record. The ad tech company reported better than expected for results from the second quarter, but analysts are increasingly concerned about competition from Amazon. I think this is an overreaction. Basically, there's two kinds of ad suppliers. There's supply side and then there's demand side. But I would be on the supply side, where if I have let's say I'm doing like a 10-minute YouTube video and I have a 1-minute ad slot, advertisers can bid for that ad slot. Now, obviously, advertisers are not doing this. I have 16 subscribers on YouTube. This is not happening. But there are platforms that work on supply side that connect people that wish to advertise their products to those advertisers that have ad slots open. Demand side is the other side of that, where they work with people who wish to run ads, and then they go to the supply side and work with the people that have ad slots. Google is a good example of demand side, where they have advertising space. If you run a Google search, very likely you will see a promoted post. That is companies that have products that they want to advertise selling demand side to Google. So Google is obviously the biggest player in this space. Google obviously has a giant platform, and so this sort of set the price, whereas the Trade Desk has a lot more flexibility in terms of what advertisers they can work with and where they put those ads as well. Whereas Google doesn't have a ton of flexibility as to where they can put ads, and they can only put ads in search, which obviously search has a lot of volume, but they don't have a ton of flexibility in terms of different mediums of which you can display ads. The company was trading at over 101 times free cash flow at the beginning of the year, and it has since fallen to under 30 times free cash flow. Honestly, if the worst thing that's happening at this company is growth is slowing very slightly, remember, they only missed revenue estimates by 2%, and their stock fell 40% because of it. And then their CFO departed. Amazon has an incredibly wide marketplace where you you can advertise. The problem is they don't have flexibility. It's great. And the other problem is, like, with Amazon ads, you have to submit to the Amazon ecosystem, which they take a chunk of your profits. Here's an article from Ad Exchanger. When the Trade Desk sneezes, ad tech catches a cold. There's been the case since the Trade Desk reported its Q2 earnings on Thursday, and Wall Street investors, nonplussed by DSP's performance, seemingly downgraded the entire programmatic sector. Unlike when the Trade Desk reported its Q4 2024 earnings in February, when the company missed its own revenue forecast and the stock cratered, last week's earnings debacle isn't actually about earnings. Rather, investors appear mostly flummoxed by the Trade Desk's competitive positioning with Amazon. Youssef Squali, managing director of digital media and internet stocks for Truist Securities, was the first to broach the subject on last week's call. He asked CEO Jeff Green, from your vantage point, have there been any meaningful changes in how Amazon has shown up competitively in the market? Amazon Ads primarily buys Amazon-sponsored product listing ads and ads on Prime Video and other media owned by Amazon, none of which overlaps with the ads the Trade Desk bids on across the open web, Green said. Whether you look at it from that perspective or from the view of a certain view, Amazon is not a competitor, Green said. Amazon is more of a potential partner, honestly. But investors clearly did not want to hear that message. The accepted narrative in the market is that Amazon DSP is voraciously coming for the Trade Desk's business. Amazon ad growth rate was 22% in Q2, reaching $15.7 billion. Investors wanted a stronger rationale for the Trade Desk's superiority, perhaps, and a more straight-on acknowledgement that Amazon is its main competition right now. Like I said, I'm not buying it, right? It just doesn't make sense to me. The Trade Desk does not compete on Amazon for ad space, and they don't compete on Amazon Prime Video for ad space. So it doesn't make any sense. Why would Amazon be a competitor? Are people that like use the general open internet, are they going to move to Amazon? Are they going to stop ad spend on all other platforms as they move to Amazon? Is it that lucrative? I don't think so. I don't find it to be the case. The Trade Desk is suddenly this incredibly toxic company. So yeah, I don't buy the story that Google or Amazon actually are a big threat to the Trade Desk. I think that they operate in sort of a niche enough part of the internet advertising space that they can sort of continue to grow in that way that they have demonstrated they are able to grow over the last couple of years. And I think given the gigantic multiple compression that we have seen over, especially this last year, I think the Trade Desk is increasingly becoming an incredibly interesting company to look into. Again, going from 101 times free cash flow to 28 times free cash flow is based off of evidence I don't think that is material to the company. A lot of people seem to think that the Trade Desk is kind of like doomed because of like Amazon doing ads on their own platform. I don't see that as necessarily the most pressing threat. I think the Trade Desk is certainly something to look into a little bit deeper. They have very strong free cash flow. They have very strong earnings just in general. They have a very good cap on expenses, and they're also buying back shares. There's a lot to like in this company, and there's a lot to like a couple of years ago. The only problem was valuation, and now valuation has sort of come back into the realm of reasonability. And so I think with that, there's a lot more opportunity here. And hey, if you enjoyed this brief overview of the Trade Desk, go ahead and subscribe and come hang out live. We love to talk stocks and all the goings on of the market. Link in the description.